Hello everyone, we will be starting with a new topic, that is the liquidity transfer pricing. Now this chapter is very important from the exams point of view as well as for the knowledge point of view as well. See, before this financial crisis of 2007 and 9, there was basically a myth among all the financial institutions. And what was that myth? They feel that liquidity was available easily. Liquidity is available easily and without any additional cost. So this was the basic myth, and if this myth would have been truth, okay, then there would have been no financial crisis during the 2007 and 9. Why? Because the crisis of 2007 and 9 is because there is a liquid crisis. Means if this is a HSBC bank and now they don't have the fund and they need the fund, and if they would have received the fund easily, they would have survived. Okay, similarly if you look at the institution which failed, okay, if we will talk about the Lehman's brother, okay, they have to square off their positions. Why? Because they don't have the margin to post, they don't have the collateral to post against the derivative position which they have acquired. So at the end, what happened? They filed for the insolvency. So what is this? Because they don't have the availability of the fund, they won't be able to carry their contracts forward and they have to stop it immediately, and at the end, stopping them immediately at the current price make them like booking up the huge losses, and these losses are way beyond the equity and the assets they hold. So at the end, what happened? They have to file for the insolvency. Clear? So after the financial crisis, the regulations also got to know that liquidity is one of the major concern. That's why if you look at the Basel III, they have also included some of the concepts which are completely based on the liquidity maintenance. Clear? So in this chapter, basically what we are going through is we are going to wind up so many concepts which we have studied earlier in our liquidity only. So this is important from the exams point of view as well as for our knowledge point of view, that yes, liquidity is important and we need to take the steps. Okay, and these steps are towards the maintenance of the liquidity. Why? Because it involves some amount of pricing. Liquidity involves the cost. Means if HSBC is the liquidity receiver and suppose Royal Bank of Scotland is the liquidity supplier, and during the financial crisis he is going to charge higher amount of funds from HSBC in order to provide the funds to HSBC. Clear? So if it would have been the normal days, HSBC would have received the fund easily, but now we are into the stress scenarios, stress situation, financial crisis, that even RBS bank require so much of huge charges as well as the collateral just to give additional fund to HSBC bank. Clear? So it's about liquidity transfer. What he is doing, he is trying to transfer the liquidity, and for which he is taking the price. Okay, HSBC was feeling that there is no cost and easily available, but during the financial crisis HSBC proved wrong and he need to borrow the money at the higher cost. This is what we are studying all throughout the liquidity portions. Now one more thing, till now we have covered so many chapters of our liquidity. So one thing we have seen, there are basically two kinds of liquidity. One is the funding and the another one is the market liquidity, in which are you able to sell your assets at a reasonable price or not. But you will see that most of our topics are focused towards the funding. Do you know the reason? The reason is that if you look at from the bank's point of view, our topic is mainly towards the banking and the financial institutions point of view. So they are not much into dealing with the market investments. Okay, they are much involved into taking the deposits and giving that deposits in the form of loan. Clear? So bank are not much, I'm not saying that they are not impacted with the market liquidity. They are impacted with the market liquidity, because even the bank also holds some of the securities in the form of investment in their hand, and sometimes they need to sell it into the market, and if the market is liquid they can easily sell it, otherwise they will find the difficulty to sell those assets. So if I want to divide that, the percentage on which basis these two liquidity are going to impact the financial and the banking institution, so 80% the funding liquidity is going to impact, and only 20% the market liquidity is going to impact. So what is most important for them is to borrow the money from the market, clear, rather than selling their asset. They are heavily dependent on borrowing the money either from the other banks or from the central bank or from the Fed reserves. So there are so many options from where they can arrange the funds. Even the repo market is again one of the major uh, contributor in funding liquidity, because bank needs that repo market for overnight borrowings, clear. So our concepts, our topic are heavily focused towards the funding. So even in this liquidity transfer pricing, we are concerned with the funding liquidity risk, that what about the funds we do have and what we are taking, what we are making sure that we don't have to pay the higher price in future, even in the stress situation, to borrow the funds from the market. So for the future we are planning it today, clear. So first point of this chapter is that before the financial crisis of 2007 and 8, there was a general assumption that funds are easily available at a no cost or a very low cost, clear. So there was no financial institution or banking, they are focused for liquidity maintenance, because they have the myth that liquidity is easily available at no or a very low cost. That's why they always try to fund their long term assets with the short term borrowing, because they knew that in the coming time they are going to get the liquidity easily, clear. So this was the common practice which the banking and the financial institution are following, clear. But after the financial crisis of 2007 and 8, the liquidity will become an the important concern, not only for the banks but also for the regulators. Even they need to step into and bring out the rules and regulation for the liquidity maintenance, clear. So during the financial crisis of 2007 and 8, the bank got to know that yes, they need to pay the price in order to acquire the liquidity, because if you will see the market in which funds are not easily available, so there are only very few suppliers of the liquidity. Okay, you are going to get the few lenders of last resort. Okay, we call it generally for our central bank the lender of the last resort. Means when there is no one to help you, the lender of the last resort means the central bank is going to help you. So during the financial crisis, during the tough times, there are only few lenders who can lend you the money, but if they will lend you the money, they are going to charge you higher prices, clear. So after that financial crisis, liquidity have become one of the most prior concern for all the bankers as well as the regulators. So after this 2008 7 and 8 crisis, there was a 2-year deep thorough research on the liquidity crisis, and after that the Basel committee, they came out with some standards. Okay, that is the liquidity standards, clear, and that will become the part of Basel 3 capital regime. Okay, now the banking industry, they have to follow these liquidity standards which are there in the Basel 3 capital regime, and the banks have to follow some of the ratios given in the liquidity standard. One is the LCR, the liquidity coverage ratio. They have to maintain this liquidity coverage ratio. Apart from this, NSFR, that is net stable funding ratio. These two are the ratios which are mentioned in our Basel III capital regime, and banks need to maintain those ratios. Apart from this, bank need to do the stress testing, and based on that stress testing, bank must have to survive minimum 30 days. Now this 30 days also one of the most important criteria, where what we want is that bank must have the adequate high quality assets so that they can survive the stressed liquidity scenario. Now see, word which I have used is stressed, not only the stress scenario, the stressed liquidity scenario means the scenario where I am having the issue with the liquidity. Okay, the stress scenario can also concern only with the market also, but here I am concerned with the liquidity. Clear? So based, this 30 days are based on our liquidity coverage ratio. And what this NFSR is saying to us, this is basically giving the bank the idea that you must have the stable source of funding over the long term. Means I am talking about the friends who can lend me the money even in the worst case scenarios. Clear? Now coming to our one of the important concept of liquidity transfer pricing. Clear? Now what is the need of this liquidity transfer pricing? See, the bank needs the liquidity. So with respect to this, there are three important things concerned. One is the cost associated, one is the risk associated with the liquidity. Clear? And what are the benefits associated with the liquidity? Clear? So if say HSBC bank, they want to enter into a new business. Okay, so now before entering into the business, they must take their judgment based on the liquidity. Okay, means they need to account that what is the cost to the whole HSBC organization if they are opening this new segment or new business line. What are the risks associated with this? Okay, and what are the benefit associated with this by keeping only the liquidity in their mind. See, there, when someone wants to do a new business, they have lots of things to do research on. So among this, the one more new concept added was the liquidity transfer pricing. Means what? If HSBC say want to enter into the investment banking business line, suppose, okay, though they are into, but I am just assuming that currently they are not, and now they want to enter into. So if they want to enter into, HSBC need to transfer some of the fund to the business line. And in case of the liquidity crisis, how they are going to get more funds? What are the costs associated with this? Now what are the different benefits and what are the risk associated with the liquidity? So all these things now they also have to take into their mind. And now after taking into the cost, risk and benefit, if they think that yes, doing this business is feasible, they should enter into the business, otherwise they should not. Apart from this, there are many things they need to do, such as like NPV. Okay, means whatever the money they are going to get, whether it is worth to enter into or not. IRR. Okay, there are lots of examples. So it's not only the one thing, it's the part of the whole process. Clear? Now if I'll talk about a particular RBS bank, the Royal Bank of Scotland. Now they also need liquidity as well as they provide liquidity. Clear? Now RBS, Royal Bank of Scotland, they ignored both the cost which when they want to borrow the money, they are not taking into account any liquidity cost, as well as when they are providing liquidity to someone else, even at that point of time, they have not included any of the cost. Means when I am concerned with the assets. Okay, if I am saying that based on my assets which I have, on that basis I will acquire the funding, but on those assets I'm not concerned about the liquidity cost. Clear? As well as the liabilities. Okay, means what? I am giving more. So in case of liabilities means what? When I am providing the liquidity to someone else, okay, at that point of time I am also not concerned about the cost. And at the time when I am in need of money and suppose I am selling my assets to get the fund, even at that time I am not putting any of the cost on my assets. Clear? Now see, if this is a Royal Bank of Scotland and they are providing the liquidity to HSBC, in that case RBS will demand for the transfer price, because they are transferring the liquidity, and during the tough time RBS can demand for some additional amount of cost. So who is the liquidity consumer? He is the liquidity consumer. Who is the liquidity supplier? He is the liquidity supplier. So consumer will pay a transfer price to the supplier. Now cost and benefit will depend that how consumer is using that funding. Okay, suppose RBS is giving the loan to HSBC at say 4.5%, but HSBC is using that fund to earn say 8.5% of return. So there is a clear cut benefit of 4.5% to the HSBC bank. So it is dependent on how the bank is utilizing that fund, and based on that they are going to calculate the cost and the benefit for the bank. So whenever the banks are preparing their overall risk strategy, they always include this liquidity transfer pricing. Clear? I'm little bit diverting from my topic, but this information is really helpful. Okay, now when it comes to the preparation of risk management strategy, who takes into part? Okay, we have studied about it also. It's the ALCO. Okay, what is this ALCO? Asset Liability Committee. Okay, Asset Liability Committee. Now what is their task? They are the risk governing bodies. Means it's their duty to govern, to manage the risk of the organization as a whole. Clear? So usually under them there are the bank's treasury controlling, risk controlling, as well as the reporting. All these parts are coming under the ALCO. Clear? As well as ALCO also take participation in approving the LTP system, means the liquidity transfer pricing systems, and what are the parameters for the liquidity transfer pricing. Apart from this, ALCO have the task of setting the goals. Okay, what are their liquidity goals, as well as their strategic decision also included in this. Means first of all they need to see that what is their liquidity appetite, means how much risk they can really attain, how to get the liquidity during the tough times. So all these things, all the decision part, the management part, governance part are coming under this ALCO. Now there is a word used, that is the liquidity cushion. Means if I am saying that I my risk appetite is $850, okay, what I need to do, should I keep this $850? No, I will keep at least say $940. I will keep the additional cushion of $90. Now if you want to understand this in more detail, suppose there is a aeroplane landing, and if the road is the road where the plane lands, okay, actually the runway, it was up to this path only, and suppose if the airplane won't be able to stop up to this point. So what will happen? It will fall down. So that's why we are giving some extra runway to the plane. If might not be, if that he will not stop at this point, at least he will stop at this point, or at this point, or at this point. Means this is something where we don't feel that it will cross even this at a very low probability, means even less than 0.1, but it will somewhere stop between this. So we know that we will stop by this point, but we need to have some extra cushion. Okay, or in other term we can say we must have a buffer. Okay, we have also studied this asset buffer, means to have something extra in our pocket so that we can cope up with the difficult time. Clear? Now next important point that about LTP is that it is managed at the central level, not at the decentralized level. Means it is managed from the top, okay, centrally. If I'm saying that the HSBC have the different business lines, and if I'll start making the LTP at different business level, it is not going to be useful. Okay, so for the firm as a whole, for the organization as a whole, the LTP process is managed. Clear? Now there is next important term is the liquidity funding rate. So bank usually calculate their liquidity funding rate, that at what rate they can provide or at what rate they can take the money. And how they are calculating this liquidity funding rate? So it is based on two things. One is the marginal cost of the fund, means the additional amount they are borrowing, how much cost they are paying for this marginal cost of the fund, and the maturity. Okay, means matching the maturity of their product. We can say matching the maturity of their product. Based on these two, they take the decision at what should be the liquidity funding rate. So just like if we'll say that we want to find out that what will be the funding rate, so there will be some base, okay, the reference for it, and that reference usually used as the LIBOR. Okay, or apart from this there can also be a swap curve. So based means they will keep these two as the base, and on that base they try to calculate that what could be the liquidity funding rate, and these two are the basic factor which are going to impact the decision of the institution. Okay, so there is one concept. Suppose if I'm looking for the bank's point of view, if the bank is making a loan, means what? The bank is giving money, bank is taking the deposit, means what? Bank is receiving the deposit, means bank is receiving the money. These are classified as the assets, these are classified as the liabilities. So when bank is giving the loan, so bank should charge them additional premium, that is liquidity premium. Clear? And when bank is receiving the money, then they should pay the liquidity premium, because here bank is giving the money, that's why bank is charging the liquidity premium. Bank is receiving the money, that's why bank is paying him the liquidity premium, because they are providing liquidity to the bank. Now taking this further, bank, they have some of the financial units. One financial unit which is taking the liquidity from the bank. So if they are taking the liquidity, means what? Bank is having investment in this financial unit 1, these are the assets, so bank will charge liquidity premium from this business unit. And if this business unit is giving money to bank, then bank will credit liquidity premium to this business unit's account. Clear? So liquidity premium is completely dependent on the transfer of money, that how and who is transferring the money, the transfer of money is between whom. Clear? Now, if you look at from the point of view of the liquidity and the crisis of 2007 and 9, you will find lots of structural issues inside the banks which created this such a huge financial crisis. One is the decentralized funding system. Okay, currently we are into the centralized, but earlier it was decentralized funding system, means everyone are managing their own liquidity. Okay, and when everyone is managing their own liquidity, in that case the internal controls is also very weak. Clear? When things manage at a single level, it's easy to manage, but when every department in managing their own liquidity is quite tough and difficult to control, and even from the top management it is difficult to have the proper look over each business unit. Clear? Next, the concept of cost, benefit and risk, okay, it was not there, so they failed to calculate with the cost, benefit and the risk with respect to liquidity. Clear? Along with this, earlier the employees of the means organization, they are heavily paid compensations commission on the profitability. Okay, they are not even accounting for the liquidity risk. Their main concern was the profitability, and these employees are getting more and more commission based on that how much profit they are providing it to the organization, without taking into account are they able to manage the liquidity or not. Clear? Next, the zero cost and the average cost funding approach that we will study in this chapter only. There is a zero cost approach. The word zero means what? It is automatically saying you that there is no cost of taking the liquidity or giving the liquidity. Or the next is the average cost approach. Means what? Means if you look at 1 2 3 4, there are 5 different maturities. You are saying the cost for the 1 year maturity is 10 basis point, as well as the cost for the 5-year maturity is also 10 basis points. So this concept is wrong. The reason is wrong because the higher the maturity, higher the risk, but the average cost approach failed to take into account this concept. So we can say that in the short term the liquidity risk was overestimated, and in the long term the liquidity risk was underestimated. Apart from this, the stress testing which bank were doing earlier, they are not taking into account the contingent liabilities. Okay, along with this, there are few of the factors which they are not incorporating while doing the stress testing. One is the idiosyncratic risk, means the firm specific risk. So because of all these issues, they are unable to find out the exact risk to the organization. Now if you look at this how centralized approach is working, okay, so basically in the middle we have the central treasury. So with the central treasury there are the assets department, okay, there is a liability department, then we have a trading business unit department, and we have a fund transfer department. So suppose this is one particular unit which is providing the loans, okay, or we can say that this central treasury department is giving the money to this asset generating department. So this central treasury will take the premium. Okay, we can say the central treasury is taking some cost from the asset department, and what is happening in case of liquidity, they are giving the fund to the central treasury, okay, either in the form of deposits or by issuing the bonds. They are taking the inflows of money and giving the money to central treasury. In that case the central treasury is giving some extra premium to this department, this business unit. Next we have is the trading business unit. If you look at the banking point of view, there is a one business unit which is focused on assets, one business unit focused on liabilities, one business unit which is focused on the trading business unit, means whose task is to trade. So if this trading business unit will take the money from the central bank, then central treasury will charge the cost from this trading business unit, and when they will sell their assets and provide the money to central treasury, then in that case the central treasury will credit the premium to the account of the trading business unit. And this funding transfer, sometimes they provide fund to some other bank, or they will take fund from some other bank. When they will provide the fund, then in that case central treasury will charge them, and when they will receive the fund, then central treasury will credit with the cost to department. So these are basically the four departments from where either they are getting the money or they are giving. That means the central treasury. Keep in your mind the central treasury. If central treasury is receiving the money, then central treasury will give you the credit. If central treasury is giving you the money, means central treasury is giving you the money, then they will charge some cost from you, the cost of funding liquidity. This is the simple concept. If they will provide you the funds, they will charge a cost from you. If they will take the funds from you, they will credit with the some amount for giving them the liquidity. Clear? So this is how the process of liquidity transfer pricing actually work within the organization, and this centralized department plays an important role in binding all the different units of the organization. Now if you look at some of the basics, best practices with respect to our liquidity transfer pricing. So what they are saying is easy to say but difficult to handle. First of all, they are stating that you must have very few illiquid assets in your balance sheet. Okay, you should not overweight your balance sheet with the illiquid assets. Clear? Next important point which they are discussing is the maturity mismatch. So they are saying that your assets and liability, there should not be the huge maturity mismatch. So means what? If you are taking the deposit at 6%, give the loan at 6%. So means what? You are not making any profit. That's why we take the fund at the short term, because the interest rate is very low, and give the money for the long term so that we can earn the profit. Otherwise, how we will earn the profit? Clear? As well as the bank must have a proper well-defined LTP process. There must be proper guidelines, the principles, the rules, as well as the education of these rules and guidelines is important. You need to inform all the business unit about this. Next, that there must be a central treasury who is like having the a position centralized and managing the liquidity at one place, and taking into account all the business units and department or of the organization. Bank or the financial institution, they must have the full knowledge about the funding liquidity with respect to the cost, risk and benefits, as well as the governance from the senior management and the independent risk committee. Along with that, the financial control personals. So they must overlook all the process and how this liquidity transfer pricing model is working, and they must hold the meeting at least monthly so that they can monitor the funding cost with respect to the banks. Apart from this, what compensation and the commission which we are giving to the employees, okay, the bonus which we are giving, that should not be clearly based on the profitability. Rather than it's better to calculate the profitability, means the return after risk, after taking into account the liquidity risk. And after that, if they see that yes, they have done some good work, they have managed the liquidity and provided the profitability, it's better to provide them the bonus and the remuneration based on the adjusted profits. Now it's not only the bank which internally like managing the liquidity transfer pricing. There are the regulators who are also participating in this, as well as your competitors are also there who are participating in liquidity transfer pricing, because somehow these competitors are also involved in this. So when there are regulators and your competitors are having a regular watch, so it's important for you as a bank that internally you will manage the risk and most importantly focus on the liquidity risk. So the best practices are again the challenges for implementing the LTP process, because see, first of all you need to have a proper oversight over that how you are going to manage and monitor the process. Okay, if there is any failure in the oversight and failure in maintaining the process, then your LTP is not at all going to work well. Next, the maturity mismatch is again one of the biggest concern is here. Next important concern, the challenge is the internal system. Okay, that how internal system, the your infrastructure means information system is how strong it is. Okay, is it sufficient that it can provide you the information on a regular basis, means if you are breaching some threshold for the liquidity, so in like whether it is informing you instantly or it is taking some time to inform you, because if we get to know that once the flight is missed you can't sit into the flight, so how strong is your information system which can give you the timely information about the liquidity risk. And next, setting up this remuneration policies basically for the employees, which earlier was completely based on the profit and now it's on profit adjusted for the liquidity cost and risk, so somehow their profitability will reduce and their commission based on the profit is also going to reduce, so again you are disheartening your employees. So these are the challenges which a financial institution will face while implementing this liquidity transfer pricing model. Clear? So we'll keep this much in this lecture, and we'll start in the another lecture the coming topics. Okay, so thank you.